This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th of 6 videos on channels. This video has many smaller chapters to it. I'll begin by talking about limit orders that you can use to fade tests of the top or bottom of a channel. I'll move on to talk about how breakouts typically start trends. Next, I will discuss reversals and breakout failures. Then I'll talk about broad channels and trading ranges. If you cannot tell whether or not the market's in a broad channel or a trading range, it does not matter. You trade them the same. You buy low, you sell high, you scalp. Finally, I'll make the point that every trading range has both an early bull trend and bear trend within it. Here we have a big bear bar and then a second reversal down. Traders will draw a bear trend line across the top and watch what the market does when it gets near the line. We have a reversal up, a second reversal up. Traders will draw a line and then watch what the market does when it gets near the bottom of the channel. We reverse down and then we have a second reversal down, a micro double top. The market reversed down from near the line and then it went up again and it reversed down a second time. So it's a micro double top. The market went up and down on this bar and then up on this bar and it's starting to go down on that bar. So it's a second entry short. The first entry is the market falling below that bar and then the second entry is falling below this bar. Traders should be looking to sell on a stop below the low of this bear bar. The bear bar has a decent sized body and closed below its midpoint, and it'd get filled right here, just below the low of that bar. Incidentally, this is an I pattern. This bar is inside that bar, so consecutive inside bars. It's also an IOII pattern. We have an II, and then this bar is an outside bar. It simply means the market is deciding whether to break to the upside or reverse to the downside. This bear bar closing near its low, especially at resistance at the top of the channel, makes it more likely that the bears will get a downside breakout. The bears broke below the bottom of the channel, but on this bar, the market reversed up. It tried to break out again to the downside, but by the time the bar closed, instead of being a bear bar closing on its low, it's a bull bar closing near its high. Bulls would buy either above the high of this bull bar or above the high of both bars, using a stop, expecting at least a test of the top of the channel. The context is good here for a reversal, and experienced traders might enter with limit orders as well, and they'll be willing to scale in, betting on a reversal. They'll use wide stops. For example, as the market's falling here, they'll be able to draw this line, and they know the potential bottom of the channel is here, so they'll place a limit order to buy in this general area. They'll get long when the market falls just below their limit order. If it falls the distance of a scalp, a minimum scalp lower, a lot of traders will add on. The second entry, you want it to be at least the size of a scalp below the first, so that if the market reverses back up to the first, you can scalp out on the second and make a scalp profit, get out break even on the first. If the context is good, you do not exit either and you hold for a test of the top of the channel. Most trends begin with a breakout, even though sometimes the breakout is not conspicuous. Reversal down, I can draw a line. Reversal up, I could draw a line there, but we fell below it, reversed up again. So I would replace that first line with this line. It's a channel, and it's convergent. It's a wedge. And look at the rally. Where are the consecutive big bull trend bars? The bulls had good bars here, but worse bars here, and even worse bars here. This rally is probably a bull leg and what will end up as a trading range. The odds are there'll be a bear breakout below the channel, and then the market will go sideways. Traders will expect this bull breakout to fail. The channel up is not very strong. Some bulls will draw this line, and then when the market's going up, they'll place a limit order to sell at the line. And some will be willing to scale in higher if the market goes higher. Most bull trends, in fact, most trends, bull or bear, end with a failed breakout. Here we have a bull trend. We're trying to break above the top of the channel, but we have a tail and not a particularly big bull bar. Look at the follow-through after this bull bar, a bear bar. Bad follow-through. The context is pretty good for the conversion of a bull trend into either a trading range or a bear trend. Do I want to be buying with a limit order at the bottom of the channel? Not really, especially after 3 consecutive bear bars. If the context is good for a reversal and a conversion from a bull trend into either a trading range or a bear trend, do not place a limit order to buy the bottom of the channel. We have a wedge top, weak rallies here, and now 3 consecutive bear bars. The odds are the market's going to begin to convert into a channel or even a bear trend. Look what happened here. After the 3rd consecutive bear bar, we suddenly get a very big bear bar. Not only that, look at the open of this big bear bar and the close of that bear bar. A lot of traders, when they see a reversal and they see 3 consecutive bear bars, they'll sell at the market. As soon as this bar closed, there were so many orders to sell at the market, the next bar opened below the open of that bar. That's a sign of very eager bears. And by the close of the bar, we had a very big bear trend bar. That means that bulls gave up. They were not buying at the bottom of the channel because they no longer think it's a bull trend. They think it's either going to have a couple legs down and form a trading range or a couple legs down and form a bear trend. A big bear trend bar like this on a reversal, I call it a give up bar. The bulls are giving up. And if they're giving up, they're not looking to buy a bar or two later. They're going to wait for at least a couple legs down. Wedge top, 3 consecutive bear bars. Chances are the bull trend is ending. Bears could sell with a stop below the low of the 3rd bear bar, and a lot of traders did. That's why this bar looks this way. You could also sell the close of the big bear trend bar, betting that traders now all agree that we're going down for at least a second leg, and therefore you can sell that close, stop either above here or above here, betting that the first reversal up will fail. The bulls who bought here and bought more lower are hoping to get out without a loss. They're going to sell, and the bears are going to sell as well. The bears who did not sell here suddenly now believe the market's going down. They'll look for any reversal up to sell. They could sell above this bear bar, a bad-looking buy signal, and they could also sell below this bear bar. Bull bar here, so we tried to go up, and bear bars went down. Bull bars here tried to go up a second time, and this bear bar tells me that the reversal up is going to fail. It's a double top bear flag, up, and you have a bear bar closing on its low. The market became always in short with this big bear breakout far below the bottom of the channel. Chances are we're going to get at least a second leg down. The market reversed down. It reversed down a second time. Traders could draw a line across those 2 highs. The market went above that line and now is reversing down again. So at this point, traders would replace the first line with a new line using these highs. To find the bottom of the channel, they can create a parallel of this line and drag it to the low point in between or to any of these other prior lows. Some traders will draw all 3 lines using this low, this low, and they'll watch how the market behaves. When the market got down to the line, it reversed up. When it tried to break to the downside again, it reversed up a second time, both times with bull bodies. Very strong sell-off here, but is this a strong sell-off or this or this? Much less so. This looks like a trading range through here and then a trading range through here. This is not a strong bear trend. It's a spike and channel bear trend. So very strong bear breakout and then a channel, and the channel down spent a lot of time going sideways. This bear channel probably will end up being a bear leg in a trading range or the final leg in the bear trend. Traders will look to be buying a reversal up from the bottom of the channel. And here we have a micro double bottom with 2 bull bars. Should you be selling at the bottom of the channel, betting on a successful bear breakout? Well, only 25% of the time are you going to get a successful bear breakout below the bottom of the channel. And that's even less likely when the channel is as weak as this. Instead, traders should be looking to buy with limit orders at the bottom of the different channels. As I said, you can draw channels connecting these lows. You can draw channels with a parallel, anchoring it to that low, to this low. Traders will look at any of those lines and look to buy with a limit order. Experienced traders will buy with a limit order, buy more lower. Most traders should only be entering with stops, either above this bull bar or above both bull bars. A micro double bottom. Down, up, down, up. By the way, this is a second reversal down from the top of the channel. If we draw a line from this high to that high, the market reversed down. The bulls again tried to break above the line and failed a second time, so that is a reasonable short. Most channel breakouts fail. Should you be selling with a limit order in this particular case at the top of the channel, betting on a failed breakout? Well, this is a special case. We have a spike, pullback, channel, probably will convert into a trading range or a bull trend. I would not be selling this high, expecting the rally to fail and reverse down again, especially when you have a micro double bottom and you see this bar going up very quickly like this. I would not be selling that, betting on the top of the channel, leading to a reversal down. Context is good for a bottom. a weak bear channel and a good reversal, and then we have a very big bull trend bar. What's going on here? Is this bear selling at the top of the channel? Of course not. It's bulls giving up. Bulls deciding that it's a spike in channel bottom with a good reversal. Chances are we're going to have at least a couple legs up. The bears are giving up. They're not selling here, and the bulls are buying, expecting at least 2 legs up. A big bull trend bar early in a possible trend. It's a give up bar. The bears are giving up, and it increases the chances that we'll get a rally, at least a bull leg in a trading range, possibly a bull trend. Most bear trends end with a failed breakout below the bottom of a channel. We broke out, it failed. We tried again to break out, and it failed the second time. I know it does not have a wedge shape. It doesn't matter. You could make it a wedge shape using this low and that low. It would have more of a wedge shape. That doesn't matter. The key point is it's a weak bear channel, probably a bear leg in what will become a trading range or a bull trend. Plus you have a micro double bottom. So the context is good for a swing up. Do not sell at the top of the channel. It's a strong bottom, good context, and you have a big bull trend bar closing near its high. And you have good follow through as well. Instead of selling, you should be buying either the close of this breakout bar or the close of the follow-through bar. You can also buy pullbacks. We have a bear bar pulling back after this 2-bar breakout. Traders can buy on a stop above its high, and same with here, and same with here. You can also buy with limit orders. We have a bear II, possible failed breakout, possible low 2, low 1, low 2, but strong enough bull bars, odds are buyers below that this is a bad sell signal. So traders will place a limit order to buy at the low of that bar, and they'll get filled right there. You can draw lines. You're seeing reversals down, lower highs, lower lows. You can draw that line. For the bottom of the channel, you can always create a parallel and drag the line to one of these lows or possibly even here to create a broad channel. You can also draw a line connecting lows on the way down. Different ways to draw channels. That's always the case. You never know which one most computers are using until you see a reversal up. Look at this bear bar. It's a very big bear bar. Not only is it a big bear bar, where is the last time the bears have had a bar that looks like this? More than 20 bars away. In fact, in the entire 50 or 60 bars of the bear trend, no bar is as strong as that bear bar. Whenever I see the biggest bear trend bar occurring 20 or more bars into the trend, what do I think is more likely? Is it the start of a new, even stronger bear trend, or is it an exhaustive end of the trend? It's more likely an exhaustive end of the trend. We're also down around a measured move based upon the height of this bull reversal, and that is a support level. Theoretically, you have a big bull bar. Theoretically, there'd be bulls buying here for a double bottom. There were not. If we break to the downside, it's basically a failed double bottom, and the market often falls for a height equal to the height of the neckline of the double bottom. So bottom should have been a second bottom. This would have been the neckline. Traders would look for a measured move up. Instead, we got a bear breakout below the potential double bottom. Traders look for a measured move down. The gap between this close and that low probably will close. It did close right here. This high went above that low. So this big bear trend bar, instead of being the acceleration of the trend into an even stronger bear trend, more likely it's an exhaustive end of the trend, which it was. Most sell climaxes, exhaustive sell climaxes, are followed by trading ranges, not by bull trends. But once you have the trading range, then the bulls can get a reversal up, which they did here. It would be unlikely for the market to fall like this and then reverse up here. It usually has to evolve into a trading range to stop the selling, and then the bulls have a chance at a reversal up. And notice where it's taking place, at the bottom of a channel. Obvious bear trend line, and then a parallel here. Or you can draw a channel line using these lows. In any case, it's a failed attempt by the bears to break below the bottom of the channel. It reversed up a little bit here, and it reversed up a lot there. Gap between the close of the big bear breakout and the low of the prior bar. And traders will buy. They'll buy the first reversal up, higher probability to buy the second reversal up. Here we have a double bottom, slightly higher low, but it's a double bottom, and a breakout from the double bottom, and this is a pullback. They'll buy that. Should you sell at the top of the channel? No, this is a pretty good reversal with 2 very big bull trend bars. More likely, buyers below the low of that bar. Bulls will buy the close of that bar. They'll buy the low of this bar. We got a small triangle, 3 pushes down, bear bar, bull bar, bear bar, bull bar, bear bar. So 3 bear bars, 3 sets of bear bars. So a triangle, and you have a bull bar. Traders will buy on a stop above the high of that bull bar and get filled here. I want to move on and talk a little bit about reversals and breakout failures. Different ways to draw the bottom of this channel. In any case, if the market is reversing up from the bottom of a channel, what's the minimum target? Well, the minimum target is for the market to go at least a little bit above the top of the channel. We're reversing down from the top of the channel. Minimum target is at least a little bit below the bottom of the channel. Different ways to draw the channel, so here, maybe here. The target was reached here. We got a little bit below the bottom of the lower line. Reversing up and reversing up again. What's the minimum target? At least a little bit above the top of the channel. And the bulls reached their target there, and you can see the hesitation, some profit taking at the top of the channel. Obvious bear channel, lower highs, lower lows, and we're getting a bear breakout. However, 75% of breakouts above or below channels fail. A bull breakout here, it failed. A bear breakout here, probably going to fail. Especially when you look at this big bear bar and then a bull bar, bad follow through. Bear bar, bull bar, bad follow through. Usually the breakout fails within about 5 bars. The biggest bear bar in more than 20 bars, in fact, the biggest bear bar in 70 or 80 bars, more likely an exhaustive end of the trend. Sometimes you get one more sell climax before you get the reversal. Big sell climax, a consecutive sell climax. The market probably will reverse fairly soon. Gap, this close, that low, gap, this close, that low, this close, this low. All of those are probable exhaustion gaps, and the market will probably trade above all of those lows. It did over here, making this bear bar an exhaustion gap rather than a measuring gap. Traders expect this to be an exhaustive sell climax, a failed breakout below the bottom of a bear channel. They're looking to buy a reversal up. 3 pushes down, 1 and then bull bar, 2, then bull bar, and then 3. You have a bull bar here. They'll either buy above the high of this bull bar, or this bar closing on its high, they'll buy above that high, or they'll wait to buy consecutive strong bull bars, betting that it's the start of a swing up. Another bull breakout with good follow through, they'll buy that. Here we have a pullback and a bull bar, they'll buy above its high and get filled here. Here the bears tried to reverse twice, 1, 2 at the top of the channel, and it failed. Traders will buy above the high of this bull bar, betting that the trapped bears will buy back their shorts. Reversal down from the top of a channel, minimum target is a little bit below the bottom of the channel, and that target was reached. Reversal up from the bottom of the channel, minimum target a little bit above the top of the channel, and the bulls reached their target here. However, it continued up much beyond that. This is a 15-minute chart of the euro versus the yen, and the target is at least 1 pip above the top of the channel. Reversal down, we can draw a line, and then expect a reversal down here. But look at this. We're getting a bull breakout above a wedge top. It's a wedge, 1, 2, 3, and we're getting a bull breakout. In general, if you break above a logical stop area, 50-50 chance you'll get a strong trend up, 50-50 chance the breakout will fail, and you'll get a reversal down. I have the wedge drawn here, but here is a very strong rally. A lot of traders would say that the wedge began here, so this would be the first push, this would be the second push, that would be the third push. In any case, the market broke strongly above the top of the channel, but closed strongly down at the bottom of the bar. Chances are the market's going to have at least a couple legs down. Is this one pullback 2? Very tight bear channel. It's probably the first of 2 bigger legs. So 1 pullback and then 2 or 2. Most of the time when the market tests the top or bottom of a channel, it goes beyond. It overshoots the line before it reverses. Sometimes when it tries to test a line, it reverses up before reaching the line. That is an undershoot. Here we sold off. We went down and up, and then down and up. We have a micro double bottom, but it did not quite reach the line. That is an undershoot. The market cycle, you get a breakout, and then the trend weakens into a channel, and then the channel weakens and converts into a trading range, and then the market decides, on the direction of the next breakout, up or down. We have a wedge channel and a strong bear breakout, 2 legs down, 1 pullback 2. You could even call this a spike and channel bear trend. Bear breakout, pullback, and then several steps down, and a bear channel, wedge bear channel. Even though it's a spike and channel bear trend, it's still a leg within a large trading range. Just like this is a strong leg up, but it ended up as simply a leg within a big trading range. This is the euro versus the dollar, a 5-minute chart. Most of the time, when the market tests a line, it goes a little bit above or a lot above before it reverses down. And this high went slightly above that line. That's called an overshoot. Examples of overshoots: I can draw a line, the market went above, reversed down. I can draw a line above, a bear trend line went above, reversed down. A bear channel line broke below, reversed up. So these are all overshoots. That is common. But sometimes you get undershoots. Here, I can draw a line, and the market reversed up without reaching the line. Here, I have a double bottom, and the market sold off strongly, but reversed up without reaching the line. That is an undershoot. A channel, it's an expanding wedge type of channel, but it's a channel. Channels usually evolve into trading ranges. So we have a very strong bull breakout, a weak channel here. It tried to get stronger, 3 pushes up, and it evolved ultimately into a trading range. Market cycle. You got a strong bull trend, and then a channel and a weaker bull trend. We're getting higher lows and higher highs, so it's a channel. And you'd expect a downside breakout and the evolution into a trading range, which is what we got. That's what usually happens. It's easy to confuse broad channels and trading ranges because broad channels often spend a lot of time going sideways. When you look at this, is this a bear trend, a bull trend, or a trading range? It's clearly a trading range, but look more closely at it. Getting lower highs, so it's actually the early stages of a bear trend. Lower lows, so it's clearly a bear trend as well as a trading range. Now, does it matter if you call this a bear trend, a broad bear channel, or a trading range? It doesn't matter at all because you trade them the same. You're going to buy low, sell high, and scalp. You're scalping because you do not expect any leg up or down to go very far. Even though it's a bear trend, the legs down are not much different from the legs up. It's not a strong trend. It's going to have repeated reversals, and it's better to trade it that way, scalp. Whenever the market is near a prior low and starts to reverse up, especially if it's a second entry, down, up, you buy. Higher probability to buy above a bull bar here rather than above a doji bar here. You could do either one though. Strong rally, but below the prior high, maybe a trading range, maybe a channel. Traders will look to sell. A low too short, low 1, low 2, bear bar. Some traders will sell this. Other traders will say strong pair of bull bars here, strong bull bar here. Wait for a second entry short, which is below that bear bar, and sell there. Same here, strong rally, not high probability taking the first entry short, higher probability taking a second entry, micro double top, and a lower high. You can call it a trading range, you can call it a broad bull channel, doesn't matter. The pullbacks are deep, they last a lot of bars. Bears will be selling rallies, at least for scalps. It's also a bull channel. Breakout, pullback a lot of bars, pullback a lot of bars, but higher lows, lower highs, and converging lines. It's a spike and channel bull trend. Clearly a trading range, but lower high and lower lows. So it's also the early stages of a broad bear channel. Every trading range has both buy and sell signals within it. Every trading range has both a bull channel and a bear channel within it. When you look at this, it's clearly a trading range. It's in breakout mode. However, you can say, wow, it's getting higher lows and it's getting higher highs. This is also a bull trend. It is a bull trend. If the market continues up here and you ask where the bull trend began, you would say here or here. So it's clearly in a bull trend. On the other hand, this low is below that low. This high right now is below that high. So it's also a bear trend. And if this continues down here below the bottom of the screen, and someone asks where did the bear trend begin, you'd say right here. So at this point, it's in a bear trend and in a bull trend. And that's the case with all trading ranges. They're neutral. They have bullish properties, they have bearish properties. It's in breakout mode. Eventually, one side will win. Obviously, a trading range, we're going sideways. Lower high here. Clearly, the early stages of a bear trend. However, you got a rally and two legs down, one pullback, two. It could be a high two pullback, high two bull flag, and a bull trend. Once the trading range goes on for 20 or more bars, the probability of a bull breakout is equal to the probability of a bear breakout. All reasonable swing setups have about a 40% chance of success. I say that, but there's a 50% chance the final breakout will be up and a 50% chance the final breakout will be down. There's also a 50% chance that the first breakout attempt will fail, and only a 40% chance that any good-looking buy setup or bear setup is the start of a swing. Lower highs, lower lows, bear trend. Higher highs, higher lows, bull trend, but a trading range. And that's the case with all trading ranges. There's always both the early stages of a bull trend and the early stages of a bear trend. And anytime you have a decent signal, like a high two buy here, 40% chance it's the start of a swing up. A decent sell signal, micro double top here, lower high, decent bear bar, 40% chance it's the start of a swing down. In this particular case, the bears won. A big bear bar closing on its high, and a follow-through bar, probably a measuring gap, not an exhaustion gap. And you can see the bulls kept trying to close the gap. They keep trying to make the market go up above this low and that low to close all possible gaps. They're failing. Instead, double top bear flag. This high, that high, expecting lower prices. Trading range, bear breakout, bear follow through, probably at least a measured move down based upon the height of the trading range. Here, the market fell much more than that. Getting higher lows, getting higher highs, early phases of a bull trend. If the market broke to the upside, you say, oh, of course it broke to the upside. We're getting higher lows and higher highs. If it goes to the downside, you'll say, oh, of course it went to the downside. We're getting lower highs and lower lows. Trading range always has both an early bull trend and an early bear trend. 50% chance the bulls will win, 50% chance the bears will win. Highest probability, don't enter until you see a very strong breakout. Lower highs, lower lows, bear trend, higher lows, higher highs, bull trend. This is a close-up of up here, this yellow line, just to show that we had a higher high. This high went a little bit above that high. So this is a higher high compared to that high. It's a bull trap. It trapped traders into buying a breakout. At one point, this was a bull bar on its high, looking like it was going to successfully break to the upside. But by the end of the bar, it was a bear bar closing on its low. It was a failed breakout above the top. Bulls gave up. For whatever reason, doesn't matter. Closed below the low of the past 50 or 60 bars, and a follow-through bar, probably a measuring gap. The bulls tried to close it here, they tried to close it again here, they tried to close it again here, they could not. Several attempts to close the gap fail. You have to expect the reversal down. Traders will be selling for any reason. I began by talking about using limit orders to fade tests of channel lines, top or bottom. I then talked about how most trends begin with a breakout, even if the breakout is not that obvious. I talked about reversals and how breakouts often fail and lead to reversals. Then trading ranges and broad channels. You often cannot tell them apart because they often both coexist. Most broad channels spend a lot of time in trading ranges, and most trading ranges have broad bull and bear channels within them. And that's how I finished up talking about trading ranges containing both bull and bear trends. Every trading range, always 100% of the time, has an early bull trend and an early bear trend within it. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th and final video on channels.